Good morning. I'm going to be doing a short video on forecasting markets. Quick overview of the video. I'm going to demonstrate how to enter trades within the first 30 minutes of a opening market, how to produce immediate results and gains if conducted correctly. I'm going to be showing how the gap and go strategy, how to implement gap and pullback strategy, and how to implement a stop loss to protect your assets. And I'm going to be going over what qualifies as a news catalyst. So what is a gap? A gap is a break between prices on a chart that occurs when the price of a stock makes a sharp move up or down with no trading occurring between. Usually a gap happens in aftermarket or pre-market hours and aftermarket hours. Here's an example of a gap up. You can see is this company that I've been trading. It actually gapped up on positive news. Here's a snippet of the article. As you can see on the snippet, from the previous day, it gapped up quite a bit. Here's an example of a gap down. As you can see, on the previous day, it was trading actually significantly higher than the gap down. It actually had some trouble with debt, consolidating debt. There's a snippet of the news article. And I'm going to be going over how to buy dip buy pullbacks. This is a snippet of JP Morgan. You can see on the chart it started with a bullish green candle, followed by 3 red candles where the short sellers were pushing the price down. Looks like they implement the stop loss right below the wick of the bullish candle. That's a perfect opportunity to buy. It's actually really risky, but it has huge payoffs. Okay, and as in the previous candle, I'm going to be showing what a stop loss is. You want to place stop loss at the previous close or the first bear candle, which is the red candle of the new trading day. Stop losses it actually is your own risk tolerance. Some traders have more, I guess, loose criteria for stop loss. Some people are really tight. I'm actually very tight with my stop loss orders. It's kind of like a mental thing. Once it breaches this price, you want to get rid of the trade or exit the trade. So what moves equity in the AM? You got pre-market volume and influx of orders. You got open price gaps from the previous close, which need to be up 4%. Low float stocks under 10%. I'm going to go over that on the next slide, or next couple of slides. And news catalysts. So you got positive news, you got Yahoo, CNN Money, you got FDA approvals and SEC filings. So going over a little bit of the volume criteria, you want stocks with the current volume over 100K during regular hours. That's because it's hard to exit stocks that are thinly traded. And during pre-market, you want a volume over 10K and below 100K. If it's too high or too low, it just may dump once the market opens. You need a relative volume over 2. You can see right here, ticker symbol TRVN at a current volume of 2.98 million, and the average 3-month volume was around 726,000. That's more than 2 folds. So you can know that something is going on with that. Quick example of what I'm talking about. Here's actually a scanner that I've been using. So you can see right here at the ears, it was actually trading. Let's see, I actually have a picture of it. Okay, so here's ticker symbol EARS. Looks like before this is actually the pink right here, signifies the pre-market. So it was around 18,000. As you can see, is uptrending. So you know something's going on with that stock. So what I did is I went and searched the article on Yahoo News. And right here we have some articles, some positive news. Basically, that was pumping up the stock. Another example, if the volume is too high, actually CRGE is a stock that I was watching this morning. The actual pre-market volume was super high. I know it was over $1 million or a million trading. So you can see as soon as the market opens, it just dumps. It goes below the 20 EMA, breaks. Actually, this is right here. This is actually support, or supposed to be the support from the previous trading day. Once it breaches this is kind of a good indicator of, you know what I mean, like when the price will stop dropping. But as you can see, there was just too many short sellers in this. They just kept pushing it down, and that's why you don't enter trades with market volume that is too high. Okay, so gap criteria. Gap criteria. The gap needs to be more than 4%. Gaps create interest for more traders. You want to buy the high candle at the open. Okay, low float criteria. A low float stock is one with a relatively low number of shares available for trading. Stocks with a low float and low market cap tend to be more volatile, and it can make huge moves to the upside very quickly at positive news. So it needs to be under 10% to qualify as low float. And the ticker symbol ERS is actually a low float stock. So you can see under here, shorts. Yeah, this was actually a really low float stock whenever I jumped on board. Okay, news criteria. You want positive news on Yahoo Finance, CNN Money. You want to search for FDA approvals, positive findings from studies conducted, and you want to have positive SEC filings. They're negative and they're positive. Here are some common SEC filings. The 10K is that's more of an audited, a formal annual report. Usually those can have positive and negative implications. 10Q is the unaudited quarterly report, which comes out 4 times a year. And then you have the 8K, which is basically this is any kind of announcement that involves the common shareholders. You got a pre-14C, which is basically reverse split, which is negative. You don't want to be in the stock when it comes out with that form. You got Form 144, which this is a notice intent to sell restricted stock. Usually this belongs to the corporate insiders. You got a Form 3, 4, and 5, which are corporate insiders that own more than 10% of a stock. This is whenever they buy or sell shares of the company stock. You got a Form 13D. This reveals who owns the most of the company's shares. You got a Form NT. This is when the stock won't. This is basically an extension for the 10K. Understanding SEC filings. First thing you want to do is locate the business summary. Red flags revealed in the company's footnotes. Examine the company's balance sheet. Compare gross profit from the admin. Examine net loss. So here's a snippet. The company had a total sale of $220,000. They had a gross profit of $32,000 minus the cost of goods. As you can see, they paid themselves $878,000, which is ridiculous because they only made $320,000. So here's actually the net loss of the common shareholders, $1.5 million. That is not good. Here's the pre-14C form I was talking about earlier. So when a company doesn't apply the reverse split to authorized shares, well, you want to sell. You can see right here, they want to raise. They want to raise 500 million shares, which is crazy. I mean, these are why you don't invest in penny stocks, because usually these just go under. They have too much debt. So this concludes my video.